Download our complimentary guidebooks, checklists, and other useful financial resources at savantwealth.com/guides.
Well, hello, everyone. My name is Jeff Lewis, and I just want to thank you all for attending today's webinar, Replacing Your Paycheck in Retirement. As I mentioned, my name is Jeff. I am a financial advisor here in the Rockford, Illinois office. And I'm really looking forward to have the opportunity to talk to you today about one of the core topics that comes up from day-to-day perspective. And I have a colleague of mine to join me here today, Teryn Fitzgerald. Teryn, thank you for joining us.
Yeah, thanks. Glad to be here, Jeff. I think this is a really great topic. We're going to have some nuggets that I think people will get to walk away with today. All right, so kicking us off, Jeff will start with the agenda that we have for you today.
Perfect. Yeah. So we've broken this topic into 3 different parts, of which I will probably do the majority of the first part, and then I will pass it off to Teryn to kind of close it out and round up the session. But first, just kind of starting and thinking about planning for that first paycheck, right? So you're getting ready, you're thinking about, what potential retirement looks like. And, you probably have more questions than maybe you do answers. And so I think it's important to kind of understand, obviously, the different things that come with this, and then obviously providing different solutions based on where you're at today. So as we think about risks for retirees in retirement, I kind of break these down into kind of what you can control, personally for yourself versus things that are outside of your control. And so there's, a handful of different things. I think today we mentioned 5 on the slide. But when I think about, okay, things that are in our control are our spending, kind of our willingness to take risk, not necessarily the ability, but our willingness to take risk. But then there's things outside of our control, like inflation and market volatility. To a certain extent, longevity is out of our control. I'm sure one would argue that you could control your longevity based on how well, you take care of your body today. But unfortunately, none of us know when our time is up, and unfortunately, nobody knows when their clock is going to tick last. So when I think about all of these things that retirees are facing as they're transitioning from the world of having a paycheck from their employer, or maybe you're a business owner where a business has been providing you cash flow over time, you're now moving into a different part of life that's going to look and almost certainly feel differently going forward. And how you navigate kind of these 5 areas, I think is important, knowing that it's going to change. If there's one constant in life, it's change. There's no static retirement plan. Obviously working with a lot of different individuals, nobody's situation is the exact same. And so going through those time periods and making adjustments, because adjustments are almost always required. That's always at kind of the core of anybody's retirement. So thinking about withdrawal rates, I think the evolution of the conversation behind withdrawal rates has changed over the years, especially in the last, I would say, 5 to 6 years, particularly coming out of the pandemic. I think the pandemic changed a lot of things in terms of how people treat their retirement and how they're thinking about things a little bit differently now. There is a huge uptick in people who are easing their way into retirement through part-time work. And obviously part-time work means you have a little bit of income in the early portion years of retirement, which obviously goes back to directly impacting what your withdrawal rate on the portfolio will be. And so I think there's always kind of 2 factors when you're thinking about withdrawal rate. It's what's the time frame you're working with. Some people may be working with a shorter time frame based on their retirement. Other people may be working with a much longer time frame. And so that's always one of the first things I think about. And then obviously, secondly, one of the core decisions you can make from an investment perspective is just your asset allocation strategy. So basically the mix of assets you have between stocks, bonds, alternatives, cash, things of that nature. Those are really 2 important considerations as you're thinking about what a withdrawal rate looks like and where it's going to continue to go going forward. So when you're thinking about assessing kind of your current situation, what are the things that you should be thinking about? whether it's from an income perspective or from an asset perspective. And so as we kind of go through this list, you'll see there's various different things that we think about as in terms of kind of the sources of retirement income that you may have. So when I think about it, there's things, obviously there's always cash. People, tend to, have cash within the bank. There's things like pensions, social securities, brokerage accounts, retirement accounts, all of these different sources of income that you potentially have as you're about to navigate on that next journey of life. How does this all fit in together? Because one person may say, okay, well, I'm going to work part-time. And another person may say, I don't care at all to work part-time. I worked for 40 years and I'm done. So everybody's plan's going to look a little bit differently from that perspective. And so when I think, okay, you got to take into account cash, dividends, interest, social security, rental income, part-time income, all of those things can feel like a lot, especially if you're not, a self-proclaimed specialist in this area. That's a lot to think about. And quite honestly, a lot of people, as they get into those retirement years, they may not care to think about those things. And so as you start building out kind of a net worth statement or kind of looking at what are my sources of income, these are generally, at a high level, things people tend to think about or have on their list. So then kind of the next phase of that and thinking, a little bit deeper about sources of retirement spending, right? So as we kind of work through this and work through the list, it's like, okay, you have all of these different income sources, but what does it really mean as it relates back to you in terms of how your lifestyle is? As a financial advisor, in some ways, I hate the term budgeting because one, generally speaking, people are pretty bad at budgeting. It's more about fitting their lifestyle to what it's grown accustomed to and how they transition that into their retirement. So, if you're one of those people that struggles with putting together a budget, it's just something that you're not good at, or you just don't really get a lot of energy from that process, there's other ways to approach this. But at a very base level, keep it high level, don't get into the nitty-gritty. Some people, I'm sure we've got some engineers on this call, love the budget worksheet. Kudos to you guys, that's great. I think it all depends on how your brain thinks differently from others. Obviously, there's individuals and families that love budget worksheets, and then there's other people who do not. And so maybe potentially as a solution for those, who are not as adept at using a budget worksheet, the way I always back into it in terms of like, how am I going to replace my paycheck? Take your paycheck and multiply it by either 24 or 26 pay periods. That gives you your annual take-home pay. That's probably what you're spending. On average, some people may be sweeping monies into savings accounts as part of that, but on average, that could be what you're spending. And maybe that at least provides you the baseline for how you plan and start thinking about your retirement going home from there. So obviously you want to make sure you're monitoring your cash reserve, making sure you've got enough money in the bank for emergency purposes. But you certainly don't, once you're on a fixed income, you don't necessarily want your cash balance growing too much because there's an opportunity cost to just holding that cash, maybe not getting as good of an interest rate as you may get in terms of kind of like a diversified invested portfolio. So we kind of talk about this, throughout different presentations and webinars if you've joined this before, but how do you go about building out a financial plan? I think there's a number of different ways. There's the old pen and paper calculator method, which kind of all of our finance nerds, both Teryn and I we really enjoy doing that from time to time. But obviously 21st century, right? There's a lot of tools, technology out there that helps provide a little bit more statistical application to one's retirement plan. And so I always think about things as like, okay, well, what are your goals? What are you trying to do in retirement, right? Like that's what you're spending money on. Is it, traveling? Is it traveling domestically, internationally? Is it giving monies to charity? Is it just spending money on yourself, going out to eat? Is it giving money away to family members? It's going to be different for everybody, but those are kind of your goals, right? Excuse me. And then obviously net worth statement, assets, if you have any debt, those would be your liabilities, getting a good picture of what are all the different things that I have and what are all the different moving parts. And then obviously, as you go to build out a plan, the whole goal of this is to provide more clarity and peace of mind of, at the end of the day, am I going to be okay? Like, is this all going to work out? And I think, sometimes as financial advisors, we get caught up in talking about longevity, withdrawal rates, inflation. And at the core of it, what most people are really trying to answer is, am I going to be okay? And so I think going through an exercise and putting a plan together and thinking about not only the next 1 to 3 years, but thinking about over the next 10, 15, 20 years, how are the decisions and the spending decisions that I make today? How is this going to impact me going forward as I enter into this next phase of retirement? And so we always think about it from a stress testing and scenario planning, knowing that there's a lot of different variables once you retire. And it's not always in your control, right? So what we'll see on the next slide is kind of going into stress testing, looking at different Monte Carlo scores. So for those of you on the call who are not familiar with a Monte Carlo analysis, essentially what it is it's a statistical application of different scenarios of a retirement plan. And at the end of that statistical modeling, it spits out a number that says X% probability of success. And so there's really kind of 3 different ways to interpret it at a very high level. Obviously, there's a confidence zone that you see here up on the screen, 75 to 85%. If you're below the confidence zone, probably means that there's areas for improvement, that may be a little uncertain whether the monies may last throughout your retirement. That doesn't necessarily mean you can't retire. It just means that you need to understand some of the risk related within your plan. The inconfident zone, this is where we talk about, this is kind of like, in some ways it's the money zone. This is where you're in a good spot, you're spending an appropriate amount, you're probably enjoying life enough for you where you're maximizing your lifestyle today. This is a really great spot to be. And then the above confident zone, this is where you get into the conversations around, hey, we've solved, potentially for your retirement, but because potentially this person or individual or family member has been a good saver, or they live well within their means, there's an opportunity for the potential to leave more monies at the end of your life than maybe what you have today. And those are really the conversations where you start thinking about, how can I impact others? How can I impact charities? How can I impact family members? Whatever it may be, how can I potentially maybe enhance my lifestyle more today? That's when you start getting into these conversations of, how can we increase your lifestyle to make sure you're maximizing your retirement, knowing that eventually you're not going to be able to do some of the things that you want to do, whether it's go on family trips, play golf, vacation internationally, give your time away to charities or philanthropy. You're not always going to be able to do that forever. So how do we maximize this window of opportunity during this time period? And sometimes going through a stress testing scenario, kind of confirming statistically speaking, like, hey, you are going to be okay, or maybe there's room for improvement, I think provides the opportunity for somebody to have peace of mind knowing, okay, this is where I stand and this is how it's going to impact me over the next 20 years. So just a couple of different modelings, obviously, just as examples. There's always the base scenario, and then you can kind of play with it, whether you retire early or whether you want to spend more. I think the key takeaway from this slide is knowing that you can pull different levers one way or the other, and it's going to increase or decrease that probability of success one way or the other. And so, as you think about scenario planning and you think about, well, what's really the most realistic? Because for some people, reducing their lifestyle it's not realistic, right? You've grown accustomed to a certain lifestyle. So maybe it's potentially, working longer, picking up part-time job in the interim. Obviously, Social Security can come into play with some of these decisions as well. But how you think about those decisions and how it actually impacts that lever on the probability of success, that's really the goal of the financial plan, is to give you a starting point and hopefully a confidence level saying like, okay, all right, I feel better about my situation today. How do we move forward from here? And so kind of segueing now into, how do you make your paycheck last, right? So it's like, how do you create a paycheck? Okay, well, creating a paycheck is important, but making sure it lasts for the duration of your retirement is arguably more important. And so just thinking about it from, okay, just at a base level knowledge, wanted to share, different investments obviously perform differently over time. And for most retirees, there will likely be a scenario where you will still continue need to taking some level of risk within your overall portfolio. So as we talk through kind of inflation, historical inflation going all the way back to 1926 has averaged about 3%. Well, to no surprise, a treasury bill, which is basically in some ways an inflation protected type of investment, performs very similarly to inflation. There's obviously a little bit of a spread there, but essentially if you keep, all of your money in T-bills, well, you're not really gaining anything. You're basically just keeping the rate of inflation. And while some people may be okay with that, some people want to, continue growing their nest egg and keeping up with the purchasing rate of inflation and things of that nature. And so that's when you start looking at things like bonds and whether bonds make sense within the overall portfolio. So obviously bonds are more risky than just holding cash, because there's obviously a risk to those bonds defaulting, whether it's a corporate bond or a government bond. Obviously the corporate bond comes with a little bit more inherent risk. But when I think about bonds, it's really more about, these are stable cash flow investments. These are going to be great investments for retirees to have as they think about creating a paycheck for themselves. Because you think about going back to 2020 during the pandemic, stocks lost 40% of their value in a span of 4 weeks. And so if you were a retiree during that time period and you're taking regular distributions from your portfolio, you don't necessarily want to have to sell your stocks at a reduced value just because the market went through a volatile time period. You want to have something else in that portfolio that is acting differently, that provides stable, a stable value. And that's where bonds can come into play, is really protecting the principal value of those investments. And then as you'll see on the chart, when comparing it to stocks and kind of the growth of a dollar over the last almost 100 years, obviously stocks are going to provide the opportunity for a higher level rate of return. But it comes with obviously the trade-off of more volatility. And so my interpretation from the slide is, okay, you probably don't want all cash, you probably don't want all bonds, and you probably don't want all stocks as you head into retirement and you're starting about thinking about, making your paycheck last. The answer is you probably need a little bit of all 2 or 3 of them. And in some cases, potentially some alternative investment asset classes as well. And so, I think about it, it's important from that perspective to remain diversified, have different income sources as you're in retirement from both a stock bonds perspective. But also, don't be too heavy on one side or the other. I think that's one of the key important parts of going through a financial planning process is, what's the allocation need to be to like fund all of my goals? If I want to go to Italy or give money to charity or take care of my grandkids, how aggressive do I actually need to be to actually meet those goals? I think that's more of an important question than should I be all stocks or should I be all bonds? It really should come back to what's most important to you and the goals that you have. And so from here, I know, Teryn, you've got some good thoughts on this, as well as, from an income tax perspective and what this all looks like. So I'll turn it over to you and I'll be quiet now.
All right. Well, thanks for that. So yes, putting that kind of backing up a little bit to that slide though, that we just looked at with the stock, bonds, and bills and inflation. When we're looking at allocation or how much to put into that different buckets or types of investments, there is a way to look at it strategically and to provide some stability in creating a consistent paycheck, as well as the benefits of compounding growth over the long term. So we saw, stocks were outperforming obviously bonds and inflation, but we do want some of that principal protection or just some stability with the bond or fixed income piece. So how can we break this down that is meaningful to you guys? Well, we want to think about your portfolio just a little bit different in retirement. Leading up to it, we're usually thinking how much growth can we possibly get in that period of time? And now we know we need to use it. So what does that mean? Well, the projections that Jeff showed, we can start to look at, what allocation might make sense. Should I have 70% stocks, 30% fixed income? What kind of combination makes sense? But it also can sometimes be helpful to look at this as a time horizon piece. Especially, if you have some worries about market risks, right? So we look to have a long, sustainable plan within retirement, and knowing what each bucket does is really going to make you feel a little bit better about that. So the first bucket is going to be the short term. It's the shortest needs possible. So we usually say about 1 to 2 years of cash flow that you put into liquid types of investments. So cash, high yield savings, CDs. You're not really trying to get the best return here. You're more so having some stability that if you needed to tap into this bucket, you were able to without any market risk. And so when we're talking about cash flow needs, we're going to say what's, after a fixed income or other pieces of income. So if I had Social Security income, for example, and I needed $60,000 a year for cash flow needs, well, maybe I would say, let's put $60,000 to $120,000 in high yield savings. That way I feel comfortable that my needs are at least met on a short-term basis. And you can think of this kind of as your emergency savings. It doesn't necessarily mean it's the first place you're going to withdraw from, but it's nice to have it just in case there was a downturn in the market. On the next slide, we'll talk about those other two buckets of money there. So now focusing on the other two, this is where your stock to bond allocation is going to be very important. So if we look at that intermediate term bucket, you want about 5 years worth of net cash flow into that bucket. So this is going to help when bad market years are unavoidable as an investor, because that's just part of it. We all suffer in those periods of time, even if we prepare ourselves as much as possible. But knowing that in that intermediate term bucket, as well as in your short term needs, you have about 5 years, it really is going to make you feel a little bit more comfortable on bearing down on those rough markets. Then again, there is also the long-term bucket that's going to have more growth associated with it as well. And so you can kind of think of that as giving you the longevity of the portfolio. So keep in mind, these are high level examples, but it's helpful in knowing how to allocate the money in retirement. But every person's needs is going to be a little bit different. So it's just a little bit of a guide to you guys to put together what Jeff shared with you guys earlier, but also help you decide what might be appropriate in these different buckets of money. One consideration, though, is depending on market appreciation, the income that's being produced, and tax planning, you might tap into these buckets at various times. So I like to think of it more as a mental accounting rather than saying there's 3 different accounts, with one account with bonds, one account with stocks, and one account with cash. It's more so to say we can efficiently allocate this within one or a couple of different accounts, but mentally accounting for what these needs are producing. And that's why we select that allocation. And you might shift more, for example, if you have a large cash need like a home purchase. At that period of time, I would say, okay, it's time to take a little bit off the table, possibly in a more higher risk investment, and put it into that short-term bucket so that we know that we have that cash available to when we need it. And why do we look at doing something like a bucket strategy? Well, there's just a few reasons here. One, it just kind of makes sense. It's from a psychological perspective. It helps you put in perspective, as I mentioned earlier, how these buckets of money are going to serve you so that you don't feel so much anxiety or uncomfortable when we do have some bear markets that we will be exposed to. Most people's retirements last, 20, 30 years. So we can say with pretty certainty that there's going to be bad periods of markets during that period of time. So having something like this in place is really going to help you feel a little less anxious about your strategy. And then also it's just practical. It makes sense to have something like this in place where you have different buckets of money serving you different perspectives and purposes, and allowing you to take care of your short-term needs, and also allowing you to have that growth in your portfolio. All right. So kind of getting into the tax piece of it, everyone's favorite subject. So how do we stretch that dollar? So when we're thinking about retiring and our tax home pay, sometimes we forget that taxes are an important part of that. And not to just say, I'm going to take out of any account and, I need $4,000 a month. Let's just take it out and not really pay attention to some of that, because that's really going to add to your bottom line. And I'm going to show you how it does so in just a moment. Okay, so when we start thinking about stretching our dollars, we should really be thinking about how we can minimize the dollars that go out for things like taxes, like I said. So after walking through some exercises that Jeff went through, we should look at how much we need to spend in retirement, right? So the question becomes, well, how much do I really need to take out to also cover for taxes? Most of us are used to our take-home pay that we have through wages, and we're not necessarily thinking how much goes out for various taxes like Social Security, Medicare, federal, state. So when you're actually in charge of that, it could be a little bit different, right? So how much do I need to withhold on whatever I take or make estimated tax payments? This is where tax planning is going to be really important. And you can work with a financial planner or an accountant to help you uncover this. You don't have to do this alone, because taxes can be fairly complicated, unfortunately. But it really is important to start to do some tax planning even before you're heading into retirement, because it's going to stretch those after-tax dollars. And we can look to see if there's potential savings before year end and strategies that might add to your bottom line over time. So first thing goes is tax planning based on your brackets. Now, you don't have to memorize brackets, and I would actually advise not to, because they change every year, and depending on tax law, they might change again. So, it really is just to kind of work with, like I said, a professional on knowing what is in your bracket and take advantage of what is there for you. So once your return is being prepared, it's kind of too late to do too much about what that year went like. So why tax planning is important is because you're planning ahead and saying, let's look at these brackets together. Let's see how I can take advantage of whatever the bracket I am in currently, or look to see if there's room to do some tax savings strategies as well. This is going to set you up for long-term success, to not just set it aside and not think about it, but taking a more proactive approach in planning is really going to make a big difference. One thing I want to mention here, though, is IRMA. So this is everyone's other favorite topic, is Medicare premiums. This is going to be based on those tax brackets that I mentioned earlier. So you are going to have to be paying attention to your tax brackets, because the premiums will change over time, and it's based on your income 2 years prior. So if you're not really paying attention to it, you might get a bill from Medicare in 2 years that says, hey, your premiums are now $244 per person, and they used to be 174, and you're like, well, what happened? It was 2 years ago that something happened. And so this is kind of a hidden tax. So as we go through tax planning, you also want to be aware that brackets don't necessarily follow these Medicare premium brackets either. So you have to look at that as well if you're trying to really make sure your premiums don't go up in the future. It's not a nice surprise to get that adjustment in a couple years. And if there is one thing I'd like to share as a kind of a fun tip is that you can adjust the premiums proactively if there is a reason for the fact that your premiums went up, like loss of income. So a lot of times when people are first retired, and if they're heading into Medicare, the Medicare premiums are going to be based on their working years, and those could be higher than where they're at today. So in that case, you can fill out a form or call the Social Security office, and they're going to be able to adjust those premiums proactively for you, so that you can get the right bracket and not based on when you were working at possibly a higher wage. All right, but now back to making sure those after-tax dollars are stretched. Well, when we look through this, we want to make sure we understand the difference between the different types of buckets when it comes to your accounts. So we talked about buckets when it comes to allocation and diversification, but there's also a difference between the buckets of accounts as well. So we have taxable accounts, tax deferred accounts, and tax-free accounts. Taxable accounts are similar to brokerage accounts or individual joint accounts. So these are accounts that you didn't, I'd say they're non-retirement accounts, basically. They're accounts that you didn't get a tax break in some sort in, you saved your after-tax dollars into it, and you invested it. So those types of accounts, the income being produced and gains when you sell the securities are going to create income. The income from interest and non-qualified dividends are going to be taxed at ordinary income tax brackets, which was that slide that I showed earlier. And that can be as high as 37%, where capital gains and qualified dividends are going to be taxed at capital gain rates, which can be as low as 0%. Unfortunately, again, these don't add up just perfectly with brackets because nothing taxes is ever that easy, but working with a professional can help you decide what these things will mean to you. But the big takeaway from this is that that's pretty nice. That's if you sell securities, you might be taxed at 0%, even though your tax bracket is 12 or 22%. So keeping that in mind is important, because when you're making the decision of what to take from what account, the tax rates are going to add to your bottom line over time. And we have a really cool example to show you that too. So the next type of account is going to be that tax deferred account, as I mentioned. That's where most people, save the bulk of their retirement into traditionally. So the 401k, your IRA, pensions are another bucket that are tax deferred, where a lot of times the money going into it had a deduction associated with it, that you didn't pay taxes on the money going in. But the downside is when you take money out, it's fully taxable. So you're deferring all the taxation, but the taxation will get you eventually. So in this scenario, if you were to withdraw, for example, $25,000, that full $25,000 would be taxed, and it would be taxed at that ordinary tax bracket that I mentioned earlier, which again can be as high as 37%. Where if we were looking back at that taxable account, it would have just been the gains that were associated with a 25,000 withdrawal. So, and it might be taxed as low as 0%. So very different consequences from taking from these different types of accounts. And then the last one is everyone's favorite account, especially later in life, is the tax-free Roth IRA or Roth 401k. You don't really get a deduction when money comes into the account. However, all of that growth is growing tax-free. So with the compounding earnings that are associated with investing, and then also, longevity of the plan, you could really have a bucket that's built up substantially over time that you don't have to pay taxes on when you make a distribution, which can be, you might want to run to that one because it seems the easiest. But as you can see, we want to manage the different types of buckets because, again, a retirement plan could be 20 to 30 years. So if you spend one of them too soon, you're going to just leave a lot of taxation for later. So when we look to see the after-tax wealth of some of these tax strategies or different buckets of money, I'm going to show you a first example of someone who is spending a couple of different ways. So this is the same person, but what if they withdrew from their IRA first? What if they spent down their brokerage account first, or that taxable bucket? Or what if they split up the withdrawal strategy among the different buckets? We don't have a Roth in this example here, but we'll show you in just a moment. But that strikes me immediately is that after 30 years, you can see a substantial difference in the person that spent their IRA first versus the person that did a 50-50 split between their IRA and their taxable account. So that's showing you right there is that's very important to pay attention to these different tax buckets, because it does add to your bottom line, and in this case, very substantially over time. Another layer to this is another strategy that we could look at during retirement, because as I mentioned on that earlier bucket, there wasn't a Roth IRA. So how can I build that, especially if I'm already retired? Well, Roth conversion is something we frequently talk about with individuals. And the reason being is at 73 or 75, you are required to take distributions from your IRA. We call that the RMDs. So in that RMD period, you have to take money out of those IRAs. As I mentioned earlier, it was all tax deferred. So you didn't pay taxes on it all this entire time. Well, the IRS says time has come, and that is at 73 and beyond, or 75. It's based on what year you were born. They don't make anything that easy. So we have two different dates we have to look at depending on how old you are and what year you were born. But a Roth conversion strategy is really going to look at your taxes now as well as in the future. So some people will say, well, why am I going to voluntarily pay taxes? Well, we're going to look at to see, are your tax rates going to go up in the future? And that could be because maybe you're going to have to take a large required distribution from an IRA in the future. If it is, well, if you're in a lower tax bracket now, it could make a lot of sense to say, let me take some money out now, pay the taxes at a lower rate, and then also build up this Roth tax-free bucket that I mentioned earlier, so that I don't have any required distributions on that. And I can use it to my advantage to take out tax-free when I need to. They're great accounts as well when you're looking at legacy planning. So if you're also looking at, I want to accomplish another goal, is making sure my kids inherit or family members inherit a bucket of money that they don't have to pay taxes on, a Roth account is also a great option for that purpose as well. So it can serve a couple different purposes, not just in your lifetime, but also for generations to come. All right, so more taxes. This here, I like this because it's kind of visual of what I'm saying is looking at tax rates, not just now, but also in the future. So you're going to see a couple scenarios here. One being just, what is going to happen if I'm not strategic, if I don't do anything within my tax brackets, do any tax planning at all, just kind of take the money out and, here you go. And then the second scenario is going to say, let me maximize the tax bracket that I'm in right now, which is 22%, and see how that affects my long-term tax brackets over time. And then the third scenario is going to say, well, let me actually even elect to take a little bit more and go into the 24% tax bracket and maximize that with Roth conversions and see how that affects my tax brackets over time. So what you can see with these scenarios is that the purplish color that has the 33% is now eliminated in the next two scenarios, the max 22 and the max 24. So when we're scenario planning like this, we can see immediately visually that it was a better option to smooth out our tax brackets over time because we don't get to that higher rate of 33% in our lifetime. We also can see on the bottom where it says total taxes paid over the lifetime that we went from 1 million to 827. So saving around $200,000 of taxes over our lifetime, which can be used for vacations and other things and legacy planning. We did this all by making sure that we're taking advantage of our tax brackets now, but also looking in the future and incorporating everything that we've discussed so far. All right, well, I said there's going to be another one. You had to know that the Roth part was coming. So then we add in that layer of what happens if I did that Roth conversion strategy. So same scenario, but adding in another element to it of taking advantage of the brackets with Roth conversions as well. So with that, we now see that the clear winner is that strategy, is that over time, because we were proactive and we looked at the tax situation, not just today, but also in the future, we were able to, save a substantial amount of money and add to our after-tax wealth in the 30-year time period. So what does this all mean when it comes to incorporating these strategies? Well, at the end of the day, it just means that we're going to be able to increase our tax wealth over time, and we're being proactive. But there are other considerations that I wanted to mention to you as well. And so I have a slide that briefly just touches on some of those as well. The charitable giving, which is going to be, things like donating to a donor advised fund or using our IRAs once we reach 70 and a half to donate to charity from our IRA. Those are great options for charitable giving strategies that can also help add to your bottom line. And then there's the consideration of healthcare, which is another thing that is concerning a lot of times to the retirees if they are planning on retiring before Medicare. How can we cover that cost? Because it can be pretty substantial. Jeff had a slide that showed inflation around 3% historically. Well, that's not inflation for healthcare. It's usually about double that. So when we really are planning for that and our withdrawal strategy, we should be looking at any options available to us. I do like to say that healthcare.gov is a great option just to explore your options. And you can, start to think about this before you're actually retiring as well, because there can be, again, some income tax planning that you can do ahead of time that will help possibly make some premium tax credits available to you. And what that does is the premium tax credit will help cover some of the health insurance premium costs. And that way it's not as expensive as if you just went out to healthcare.gov or any private insurance carrier to get insurance on your own. You can cover some of the costs that way. So with a little planning, sometimes that's available. And just making sure you're looking at those income brackets. They do change. The healthcare is based on the poverty level each year. So it does adjust, and it's also based on your income size. So that information is all out there on healthcare.gov. If you're interested, you can even see what kind of plans are in your state so that you have an idea of what that cost looks like to you. But there is definitely some tax planning that you can do to try to mitigate that cost. And then the other thing is really looking at your portfolio. We talked about withdrawal strategy, but you also can look within the portfolio itself and say, is this a year where I'm at that 0% capital gain rate? Maybe I should realize some gains this year. That way I'm kind of almost resetting the deferred gain within my account, and that's setting me up better for potentially when I need to make a withdrawal later on. Or is there some losses within the accounts that I can harvest so I can take a loss and offset some gains, or even up to 3,000 of a loss to my ordinary income. So there's a lot of opportunities there as well within your portfolio or your investments to really add to your bottom dollar too.
I've been kind of filtering through some of the questions that have been coming through. To Teryn's point, unfortunately, looks like we've got a little over 50 questions submitted within the question bank. So obviously, given the time constraints, we won't be able to get to all of those today. But trying to find a theme within the questions where maybe we can tackle as many, I guess kill as many birds with one stone as we possibly can, no pun intended there. But so I guess first question, and Teryn, I'll take this question. It seems to be people have questions around how much should I be holding in cash relative to where I'm at today from a retirement perspective. And I think this is a good question because the answer differs a little bit. I think whether you're working or once you go on to a fixed income source, right? So if you're working, generally speaking, depending on the type of employment you have, if you have a very stable job or you're in a position with a company that has a strong financial statement, things of that nature, you can probably hold maybe 3 to 6 months worth of cash and basically pay for everything else through cash flow. When you're retired, it's a little bit different, right? Because the paycheck that you're getting outside of, things like Social Security and pension, you're creating that paycheck likely from your personal savings. And so when sometimes, and, talking with other retirees, sometimes it's, maybe closer to 6 to 12 months of cash, knowing that having a little bit more cushion in the bank account on any given day makes them feel a little bit better, just knowing that they don't have to necessarily deal with the fluctuations of the market day in, day out. That can be a really comforting thing from an emotional perspective, just as an investor. So generally speaking, I say somewhere between 6 and 12 months. It differs a little bit for everybody, but as a general rule of thumb for a retiree, keeping 6 to 12 months worth of cash in the bank is completely appropriate. And then another theme that I saw as we were kind of going through this, there were questions on the budget spreadsheet and some of the comments I had made around if I'm not good with a budget spreadsheet, what's a way that I can back into that number without having to sit down and go through my bank account and figure out where I'm spending money on. Simply take your net pay home check and multiply it by 26 or 24 if you're paid twice a month. That will give you a really good idea of your net take home pay. That should provide you kind of a starting point for when you think about what am I spending? Well, if you assume every dollar that comes in you're spending, maybe that's a little bit of an aggressive assumption, but if that's the assumption you make, well, at least now you have a good baseline. And that's an easy way to arrive to that number. I think reducing some of the barriers to some of this stuff is important, right? We don't want to make this a second job or a part-time job. I guess some people do, but you try to make it, directionally correct and trying to solve for things at a high level, directionally speaking. So take your net pay home or your net paycheck that you take home every 2 weeks and multiply that by 24 or 26. That should arrive to the number. Teryn, did you have the opportunity to take a look at the question bank yet? Was there anything you saw in there that you wanted to address?
Yeah, so there's questions about Roth conversions and tax bracket planning, and that can be a little difficult to answer in this type of setting. So I do encourage, either writing in the survey or that 15-minute phone call to talk about your situation, because our experience and the gift of being able to help so many individuals is that we see so many different circumstances. So I'd hate to give you just kind of, here, do X amount for X amount of years, because it really can vary. But I'll just say that working with a professional is important, right? We can make some educated assumptions. We can build out, we have these fancy projections that we can help you really kind of fine tune to your situation and also your goals. So a lot of times people come to us and they said, well, I heard my friend did this. And, we will say, well, they might've had some different circumstances. What I know about you is X, Y, Z. And that Roth conversion maybe didn't make sense in your situation. So really make sure you look at this in your viewpoint and work with professionals when we're looking at some of these strategies. They can get exciting, and that slide, and Jeff said this earlier, we're nerds when it comes to some of these calculations, but so that slide can be really exciting to say, well, look how much my after-tax wealth grew in 30 years, but that worked for that situation, and yours needs to be examined as well.
Yeah, just commenting and continuing on to that point, when it comes to Roth conversions specifically, I think the value and the motivation around potential legacy planning, like if legacy planning is potentially something that's incredibly important to you, creating more tax efficient wealth for heirs, Roth conversions could make sense. They really could, but that's not necessarily the goal for everybody. And, sometimes that's kind of the other side of the internet, unfortunately, is you can Google anything and you can find an article that will tell you how good of a strategy a Roth conversion is. And then you read that and you think, oh, well, I should probably be doing this. But if you actually sit down and, sometimes think about it a little bit more strategically and think about, things from a legacy planning perspective, it may not make sense at all. And sometimes you end up paying a higher tax today than what you would have if you just would have left the money to heirs or whoever. So just be careful what you read on the internet. I'm sure you've heard that before. I heard it all the time growing up as a kid, and now I find myself being the one saying it to other people sometimes. So a bit of a full circle moment on that front. So well, just wanted to take the opportunity again, really just want to thank everybody for joining the call today. Appreciate the time you take out of your busy days to spend 45 minutes to an hour with us. If at any time you have questions, you're looking for more information about Savant in general, I encourage you to go to our website, savantwealth.com. We have a lot of information on there as it relates to our firm, our service offerings, and how we help people. Otherwise, feel free to schedule a call as well. If you want a little bit more of a personal touch to kind of talk through your unique circumstances, you can always schedule a personal call as well. So you all have a great rest of your day, and take care.
Thank you.
If you enjoyed this webinar, visit savantwealth.com/guides and download our complimentary guidebooks, checklists, and other useful financial resources.